actually think that crypto native assets will completely dwarf even traditional equities or real estate or whatever else is issued on chain and from the traditional world. I think a non-sovereign currency also will exist that will grow, that will dwarf all fiat currencies. And so as sort of the crypto native world starts to dwarf the traditional world, I think that's will kind of like push a lot of that. Those may be like traditional assets on chain.
This episode is brought to you by Sablier, the leading on-chain solution for token distribution. You'll hear more about them later on in today's episode. Nothing said on Lightspeed is a recommendation to buy or sell any investments or products. This podcast is for informational purposes only, and the views expressed by anyone on the show are solely their opinions, not financial advice or necessarily the views of Blockworks. Our hosts, guests, and the Blockworks team may hold positions in the companies, funds, or projects discussed. Hey guys, welcome back to another episode of Lightspeed. Today I'm joined by Matty Taylor of Colosseum. Glad to have you on, Matty. I guess maybe before we really kick things off, if you could just give a quick background. I think most people, probably most listeners of Lightspeed are familiar with Colosseum, but maybe just a little background on yourself and what Colosseum does, and then we'll jump into it.
Yeah, sure. I'm one of the co-founders of Colosseum. Before that, worked at Solana Labs and Foundation for about 4 or 5 years. And Colosseum is sort of 3 integrated pillars. The first is what most people know us from, which is our online hackathons that we run for the ecosystem. So these are the largest hackathons in the world, and get a lot of developers and founders into the ecosystem, just building really cool products. From there, we run also a venture fund. So we invest in some of the top winners coming out of that program, and then another program we call Eternal, which is sort of like our ongoing perpetual hackathon program. And so feed some of the best founders from both of those into an accelerator program, which is kind of the third pillar. We run that out of San Francisco in our new office. And we usually invest in batches about 10 to 15 teams at a time, and all pre-seed. And we're usually the only investor or the first investor in these products. So I've been doing it since 2024 when we launched the fund, and happy to jump into it.
Awesome. Maybe just on your background a little bit, I'm curious, transitioning from being at Solana to then kind of founding and building out Colosseum. Was there a point that you had maybe with you and your co-founders where you thought, hey, this type of effort needs to be its own sort of venture versus, pursuing that type of activity like from within Solana?
Yeah, I think there's a few things there. First, when we started, it was pretty clear even from when we ran the first hackathon, which was right after Solana went to mainnet in 2020, was that there was basically no one building on the network. There were some validators. There was like FTX, who was like kind of whipping up Serum at the time. We wanted to kind of start a developer ecosystem, but ultimately we wanted to get like startup founders building actual products on the network. So we ran this hackathon, and from the start, like I think we got like 60 submissions, which was like an insane amount at the time. Like that was basically like quadrupled the number of developers that were building on Solana. And so ever since there, it was pretty clear that these were being effective, not just as like a way to get developers building on Solana, which that's how a lot of people in the hackathon kind of view it as a traditional hackathon. They use it as a way to kind of dip their toes into Solana development. But it was also where a lot of the sort of venture-backed startups were forming. And so when we kind of ran the stats, it was something like 85% of all VC-backed startups, even in like 2023, were coming out of the hackathon. And so at that point, I think that was like a pretty big shift, at least from my perspective. It was like, okay, this is something that's probably even much bigger than what the Solana Foundation can handle, and there needs to be like a dedicated team. Also, at the time, there was basically no pre-seed venture funding going into the Solana ecosystem. It was like post FTX that had just blown up. And so it was like also really critical that like a venture fund and pre-seed funding was still coming into the ecosystem. And so it was kind of like, okay, we need a dedicated team to keep building and scaling out these hackathons. It needs to be its own product, basically. And we need this venture fund, and we need this accelerator to keep it going. And so at that, around that time, I think it was sort of the best time to kind of separate it from the Solana Foundation and make it its own independent org. So yeah, that's kind of what we did, and we got it off the ground in 2024.
Yeah, I think that makes a lot of sense. And you see there's a clear and kind of obvious connection there of, do the hackathons that presents a bunch of talent, and then, you can fund some of that talent and then accelerate some of that talent. I guess, is there something significant in terms of like how Colosseum's model maybe differs from like a standard accelerator, or like a YC, for example? Are you doing something different in terms of kind of like the volume of submissions to the hackathons, or the way that you kind of, get them to ship out code before pitching, and then how that turns into a raise?
Yeah, I think there's a few things that are different. Obviously, we took a lot of inspiration from YC, and you don't want to reinvent the wheel on a lot of this stuff. So a lot of the stuff that we do is sort of congruent with what they do or did in the past. And so the one area that is pretty big difference is the selection process, right? So YC, they hold this basically like kind of like college style admissions process where you fill out this written application. They then filter from that written application into like a 10-minute interview. And then from the 10-minute interview that you get like a admission into the program or not, and get the investment at that point. I guess our sort of insight is like, what if YC, instead of doing that process, watched the teams that they liked for the first like 6 to 7 weeks of the program, and determine kind of at that point is this a worthy team to invest in or not. And so our thesis is that actually they make different investment decisions based on how people are actually operating in the real world through that kind of process. And so that's kind of what the point of the hackathon is for us, is that it's like time boxing sort of an engineering sprint to see how people prioritize, how they work together with their co-founders, how they actually like go to market sometimes with their product. I mean, that's another thing. These AI vibe coding tools are basically allowing people to go to market way, 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 way faster. And so we're trying to basically get as much real world data that we see with these kind of early stage teams and make investment decisions based off of that. So I'd say our filtering and selection process is a little bit different. The other way that it's different is crypto teams often need a lot of the same things as a Web2 startup would need, like a SaaS startup or some sort of AI wrapper company or something like that. A lot of the same stuff, but there are some intricate differences. So one is like maybe more on the technical side. So a big blocker for teams is getting like an audit. So we have deals with like auditors, and we have a way to sort of accelerate people to the top of those lists. And like, so that's like kind of one area, is more on like the technical help of like connecting them either with like integrations, auditors, people that can like really accelerate the development timeline of actually like shipping out the V1 of the product. So that's like a pretty big difference. There's also, we have a team of sort of not in-house lawyers, but legal firms that we work with. And so oftentimes these protocols can have to be dealing with some pretty complex stuff in terms of like the setup. And so we help kind of make introductions there. And then the third thing is, we just have a pretty close connection with a lot of the teams in the ecosystem. Many of them are former hackathon winners, people that are sort of mentors as part of our program. And so I'd say crypto is even, because it's smaller, it's even more important that like you kind of get these warm intros to existing DeFi protocols, if that's important, if that moves things forward, or the Solana Foundation, or ANZA, or pick your ecosystem organization. So I think those are some differences. I think long term, I don't know how Colosseum is going to sort of evolve over time, but I imagine as things sort of heat up, and I think we'll talk about this with like MetaDAO, the way that we actually like even fund projects is going to start changing pretty differently, as sort of like the launch pad and tokens and how equity plays with tokens long term is going to pretty radically change, I think, the venture landscape, and especially for folks at the accelerator level.
Yeah, I think later on we'll definitely dive into that one. I think it'd be great to get your thoughts there. I think it's becoming more clear, at least, that more people in the industry are thinking about those exact things.
Yep.
Maybe before we close out on sort of what the hackathons and the accelerator and the fund does, I saw that Clay, your co-founder, recently wrote a short piece called "The Weird Corners Market," and he sort of wrote about how you guys are frequently sort of investing before it makes sense, and sort of like looking for ideas that maybe don't make sense, but something about the team or the founder, or just like the willingness to like try kind of interesting new things. Like, how do you sort of underwrite that in this context of like these weird, wacky new things that maybe don't make sense at first look?
Yeah, I think this is one thing that the hackathon does pretty well. But just generally, our thesis is like we don't. People often ask us like LPs or other founders ask us like, oh, what do you invest in? What are your theses? Like you always hear that. Oh, our fund has this thesis about what we invest in. And I think there's good reasons to do that. But ultimately, I think what we found is that like investing in a particular thesis or narrative or trend, or I guess the crypto version is the meta. What is the current meta? Is not actually a great way to invest. Partially because the big returns in venture capital are people who like create the meta, are first to that. Like they create the category, right? And so that often starts in, like, as my co-founder kind of wrote, is in a weird corner of the internet, where people maybe aren't paying attention, but maybe a small group of people or even one person is like really, really passionate and interested and is kind of dead set on bringing this sort of vision to life. I think a good example of this is sort of like MetaDAO in our portfolio, or maybe Or is another good example, or these things that maybe don't have like great, they don't really fit neatly into one bucket. They're sort of it's a new thing that they're bringing to market, and so that's what we're really looking for. Are people who have an internet connection, that want to go compete in our hackathon, that are working on some sort of passion project that they kind of uniquely are suited to go out and like build and scale and find product market fit. And so what those things are, I think it's hard to say. I mean, if you knew, that maybe that's kind of defeats the purpose, but like, I think those things are definitely out there. And I think our thesis is generally that like those are the things that are create like the largest returns and impact in terms of like growing the crypto ecosystem. So yeah.
Gotcha. Yeah, I think that makes a lot of sense. And, speaking to some other founders, I think you often hear a similar sentiment around, Polymarket and Call Shoe, for example, are so big. Prediction markets are so big. Do you want to go invest in the 9th prediction market, or like go look further out for what's the kind of the next new thing that no one's talking about yet? So I think in that context, it makes a lot of sense looking for just what's the new weird constantly. Speaking of the new weird, I guess you guys, Colosseum just announced its 4th Accelerator cohort. I guess, can you touch on, you just talked about how you're not always, defining a narrative or meta or themes that you're looking for, but at the very least, like some of the trends and ideas that maybe jumped out at you as part of this cohort. What's kind of most interesting about what came out of this?
Yeah, I think there's a few things. One is, so the grand prize winner of our last hackathon and one of the teams in our next batch is this project called Unruggable, which is a new hardware wallet and companion app that works with a bunch of hardware wallets. And so this is maybe another area of interest to us, is like, where are sort of the areas in crypto where the incumbent or the large companies in place are not creating a great user experience or product for end users, but are really critical to the development and growth of the ecosystem. And I think hardware wallets is one of those areas. And so even today, I don't know if you saw, Ledger had like another data breach. This is like something that's not particularly healthy or secure for the ecosystem and people who own hardware wallets. Also, I mean, this has been a long-term thing where Ledger has not provided first-class sort of support for the SVM Solana ecosystem. And so we felt that there was just a really interesting team that had identified some of the key things that were wrong, and we're creating a first-class kind of product for the Solana ecosystem in the form of this project called Unruggable. And so excited about what they're bringing to market. I think, I think stable coins kind of is another, I guess, like what everyone talks about. I would say for us, it's it's finding areas where there's like a lot of inefficiency in the stack. Yeah, I mean, the truth is like we're mostly investing in the founders at this point more than anything else. The products that they're building for the hackathon are interesting just in the sense that like it shows us how they sort of prioritize features and like think through specific product problems at a given time, and how they communicate with potential customers, and I think those are, and how quickly they can ship and iterate. And so most of the teams actually in our batches pivot a few times within sort of the market vertical of which they're building, which needs to also be like a big enough vertical to make sense to receive venture funding. But I think I think all of the founders that we sort of back are kind of like capable of navigating, or I guess, the idea maze and finding a product that will eventually find product market fit. And so that's what we're more concerned with at this point.
Shout out to Peaq for sponsoring today's episode. The machine economy is here. Devices are monetizing data for their users all over the world. Tokenized robots are generating revenue for token holders, and the first machine economy free zone is live in the Emirates. And it's all happening on Peaq, the machine economy computer. Head to peaq.xyz to find out how you can benefit from the age of automation. That's peaq.xyz. Thanks to Sablier for sponsoring today's episode. Sablier is the leading on-chain solution for token distribution, trusted by teams like Maple, Immutable, and Axie Infinity. The #1 distribution protocol on EVM is now live on Solana. Automate your airdrops and token vesting, streamed by the second, transparently and trustlessly. Secure, audited, and ready for Solana builders. Get started at sablier.com. As always, investments in blockchain technology involve risk. Terms and conditions apply. Do your own research.
Yeah, I think that makes sense. I was going to ask, actually, I think you kind of already answered it now, saying most founders tend to pivot maybe a couple times. I was almost curious if some of the names that come to mind are like, you mentioned, or you guys are investors in MetaDAO, but maybe some other examples are like Hilo and Reflect and a few others that kind of jump out from the prior hackathons. Like, I don't know if any of those bigger names, like their initial work, as far as like, was completely maybe adjacent or different from maybe the product that they're building now today.
Well, even I would say Hilo's a little bit of a special snowflake. It's been one of the ones that like they came in through the hackathon basically with the same concept and product that they ultimately have today. And obviously it's evolving over time. It's not just Sol that they're going to be adding. They're going to be adding like BTC and other assets to the protocol. But generally how the protocol works and the structure of how the yield bearing stable coins are produced is pretty much the same. The other two, Or and MetaDAO, definitely had some pivots. So like MetaDAO started out with more of like futarchy as a service sort of thing, where people, and I think that maybe there's a lot of confusion around how MetaDAO works today is because of this period of time where a lot of people were using MetaDAO for every single decision that a project was going to make. And I don't think that's probably the best way to use futarchy or any sort of governance, honestly. And so they've pivoted to be more of this like launchpad, and then futarchy is only used for like key decisions around like increasing the token supply and that kind of like token economics management. Something like a board would make a decision on. And then, or they pivot. They obviously started as this sort of proof of work, store of value asset. They completely pivoted away from the proof of work mechanism and now have this new mechanism that seems to be working much better. And so, I think both of those are pretty good examples of teams that have sort of pivoted. I mean, the broader vision always stays the same. Like MetaDAO is trying to give people a better governance and way of managing the token of every project, and Or is still trying to create this sort of Solana native store of value. But the product itself of how that manifests changes quite a bit. And I think those are two good examples.
Maybe to follow up on some of the, I guess, categories or trends, like I think some of the big ideas of the past several months have probably been centered around things like, I mean, you mentioned stable coins. There's been a lot of talk there, prediction markets, privacy apps. Are there, things kind of outside of sort of the major narratives or metas, if you want to call it that you think are going under the radar right now, and maybe you're start seeing some semblance to that with some of the founders and the builders that you're supporting?
I think a couple areas potentially. I don't know how this is going to manifest exactly, but and I don't think it's going to manifest how it did with like sort of the V1 of crypto AI from like I guess it was late 2024, early 2025. But it seems like sort of these like agentic payments things are getting some traction and some interesting usage. So there's like X402 standard. And so there's another project we recently invested in called MC Pay. Allows pay for MC P servers through some of this like X402 standard. Yeah, I think we see a few teams in our portfolio kind of zeroing in on this agentic kind of payments, especially for like developer like tools. So that, again, like most of the AI stuff is around developers. Most of the people using LLMs, are people using the code editors, right? And I think they're starting to pay for services as well in potentially stable coins and using things like MC Pay for that. And so that's like an area that I'd watch pretty closely. There's a project that we'll be launching hopefully this year called Tape Drive. So I think one of the interesting things about crypto is that a lot of the ideas that actually we're excited about have been talked about for quite a while, and a lot of the first and second versions just like didn't work out. And so decentralized storage and compute is another one that I think has been like Filecoin, and I think there's some new ones called like Shelby, where I think the thesis actually was pretty sound of like, can we create a way to store things in a more decentralized fashion, but also like again, going back to developers, storing people's code, but also like running that code. And so there's a project called Tape Drive that hopefully will be launching soon that we're pretty excited about, that is kind of iterating on that product vertical. But time will tell what will be interesting. It's really hard to say. These things catch product market fit not in a slow manner. It's usually something triggers where they find one customer, or they find one user that's doing some behavior that just can spread to a lot of others. And so it's really hard for me to say at this point what exactly is going to take off in 2026 and what things are going to kind of become the metas. But those are some things that come to mind.
Yeah, I think the agentic piece of that makes sense as well. Like, you mentioned the sort of early AI agent trend that we had end of 2024, and that was certainly like not driven as a result of like, consumers or users actually paying and using product. It was really more of just, I think, kind of a meme idea that was getting, blown up at the time. But I've certainly seen, at least as of lately, there's a lot more people talking about, Claude Code's amazing. You have to be using this to build all of your tasks out, do all of your workflows. So certainly seeing more interest in kind of like the tooling associated with that. So I think that makes a ton of sense. Maybe if we jump through to, I guess, a big topic for you guys, and maybe generally for the market. I think it's been top of mind for the past several months now. MetaDAO has been making waves, but Colosseum just announced recently, maybe a month ago, the STAMP, the Simple Token Agreement Market Protected, kind of in partnership with MetaDAO. I guess can you walk me and the listeners through like the origins and sort of inspiration of STAMP itself?
Yeah. So I think, and I guess it's become more common knowledge now, that like tokens in their current instantiation have a pretty big problem, and they've been sort of lagging also price wise because of those, despite having some pretty good products in the market. Like, so I think Aave is like the classic example being used right now, where the Aave product is actually pretty sticky. One of the more sticky products in the EVM ecosystem over time. And it seems to be something people want to use, but the token attached to it is maybe not represented. Like owning the Aave token is maybe not representative of what people, I guess, expect from owning sort of a financial asset attached to a project, right? And so there's kind of different angles about where we were kind of trying to figure out how to solve that problem. And it became pretty clear that it was this sort of dual track equity plus token thing that was kind of being the problem, where it's like where were founders going to divert the value of the project, or and it goes back even to Uniswap, right, where uni token holders were not getting the fee disbursements. It was like the equity holders, right? And so that, and we kind of like going back even further, it was like, why does that exist? Well, there's like all this regulation in place. You can't break securities laws, all this type of thing. But we found that like a lot of it was being set up by this sort of poor start in the venture ecosystem, which was the SAFE plus token warrant. And so for those that don't know what that is, like SAFE is the way that most startups raise funding today. It's the investment contract that YC developed early on to make it really simple and founder friendly to raise capital. And so people still use that, but with this sort of tagged on token warrant contract that says that basically like, oh, if you ever launch a token, we get like the same percentage or some percentage of the tokens as a private investor. And so that from the get-go was kind of putting people on a bad place where they were automatically trying to decide, well, are we going to be an equity-based company? Are we being a token-based company? Are we going to do both? It was very unclear what happened after that. And so that has created a lot of confusion and problems in the ecosystem. And so we were like, well, one thing that we had seen is that MetaDAO had, through its, I guess, like handful of launches, potentially solved some of the problems around expectations, ownership, and actually like protection of people's sort of rights as a token holder through decision markets, through Futurarchy. And so we were like, okay, if this is like sort of an on-chain enforced way of providing some of the protections that equity holders have and expect, maybe we can go back to the source, and like any team that wants to raise some venture funding privately before launching a token, they can use this new investment contract called the stamp that would allow people to basically dissolve any sort of, or not even have an equity entity in the first place, in lieu of just going directly whenever they launch a token. Private investors would get an allocation, public token holders would get an allocation, and team would get an allocation. And so that, I think, solved the problem for a bunch of founders who maybe were in the position of already having this problem of like, oh, we already have a SAFE plus a token warrant. How do we migrate to do it? We want to do a MetaDAO launch, but we don't know how to migrate and dissolve the entities and all this sort of complexity. And so it was kind of both to set the rudder correctly from day one, but also help some existing teams who want to launch an ownership coin do so. So that was the beginning of it. I think the response has been great. In fact, like people are already using this contract. We're already using this contract for our next batch for a few teams. And so I think we're pretty excited about how that's going to create a healthier token economy, basically.
Yeah, I think the real key part of there is distinguishing equity and token and drawing that dividing line. I think that, I mean, it makes a ton of sense. I think the market and the industry has kind of been clamoring about this for a few years now. I guess when it comes to this, like now you have this question basically of, you know, I could go one way or the other. I could do a SAFE, I could do a stamp, I could raise for future equity or future token. I guess why should founders prefer tokens?
Not all of them should, to be clear. The stamp is not for every business, you know, under the sun. It's specifically for crypto projects. And so, equity is actually a great vehicle, and people should abide by their securities laws and equity laws in whatever jurisdiction you're launching a company if you're going to do that. However, there's a whole cohort of crypto projects that I think we know don't fit neatly into sort of the equity world or the regulations around it, because the nature of their business and the on-chain sort of value that they're creating is not equivalent to, you know, orange grows, right? In the past. And so we think that if you are, you know, a crypto protocol or project that is dead set on doing a token because it actually is better than equity, or it fits more with your business and allows that, the ownership of the token should imbue some of the same protections that you get in the equity world. Our thesis is that, like, talking with a lot of more later stage investors, of like, why have you not bought tokens? So like, why have people not bought the Aave token? You know, it's a great business. And it comes down to this problem, which is like, there are no protections in place as a token holder. And so we're not even going to allocate capital into that without knowing that exists. And that's been a huge boom for just capital markets in the equity world in, you know, the 20th century, was that like you could use the US legal system to enforce the protection so that a lot of investment could feel comfortable about coming into the ecosystem generally. And so the same thing needs to happen with crypto. And I think if you are a crypto project that wants to do a token for a good reason, you have to still give token holders these same sort of rights and protections that, you know, what's amazing is that MetaDAO kind of enforces them, a lot of them on chain. And so we're pretty excited about it for that reason.
Yeah, I think MetaDAO has kind of been like a forcing function almost in the sort of lack of regulation for, you know, tokens and projects essentially. So that's been an interesting push by them. I guess I'm curious on your thoughts, like looking into the future. Obviously, there's a big push within, you know, the kind of existing traditional finance sphere around tokenizing equity and you know, bringing some of these things on chain at some point. Do you see, like, you know, token and equity just dissolving as separate concepts at some point, and it's just all equity is just tokenized and there's not really a distinction about what's a token or an equity? Or do you imagine that we'll continue to have kind of like these sort of different operating models into the future?
I mean, I don't know for sure. It seems like, at least in the current regime in the United States, that they're pretty set on bringing equities into the crypto world and tokenizing them. Same with commodities, same with, I guess, real estate, same with bonds, whatever, is all going to be tokenized because you need a way to trade them on these more efficient financial rails that are blockchains, right? And so I would imagine, tokenized equity definitely becomes a thing. Historically, that's been a pretty tricky thing to do, where you have some sort of meat space asset that you have to custody or do something with and then issue something on chain. Stablecoins seem to have figured this out, at least with dollars. And the big question is, like, can maybe large financial institutions, or even ones like Coinbase, can they figure that custody piece out, where a lot of liquidity can come in this space and it can be kind of the seamless redemption process. So I think a lot of this stuff will exist. Native crypto tokens will exist. Tokenized equity, commodities, all this type of stuff will exist. And then there's the question of just like how do you control who owns these things? And so with dollars, it's maybe less of a problem because the US loves that dollars are getting exported across the world. But when it comes to like equities, maybe it becomes more of a KYC funnel. There's requirements at the token level. So this is like one thing that also I don't think got much, or it's kind of been forgotten, I guess, in the sands of time, which is that there's all these sort of token extensions that you can do with Solana, that maybe you could like embed some of these sort of requirements into tokens themselves. And so I would imagine that starts to happen over time. So I think I think I generally believe that's why I'm here. I think all finance is going to happen on chain. So including equities.
Yeah, that could make sense. I think for a long time, that's been a question is, I would say originally, like maybe in 2022 when the SEC was pursuing kind of like action more stringently against the industry, there was a lot of question around like, how would you KYC all of DeFi, that type of thing. So, but to your point, maybe there's kind of like isolated instances or interfaces where you'd kind of KYC for certain things and you'd still have this kind of, open realm of other stuff that people can do that's kind of like, unsupervised, so to speak.
Yeah. I guess my kind of take on this is that maybe controversial take is that I actually think that crypto native assets will completely dwarf even traditional equities or real estate or whatever else is issued on chain and from the traditional world. I think it will be so much bigger. These like sort of things like Bitcoin, for instance, will grow in volume and so much. Like I think a non-sovereign currency also will exist that will grow, that will dwarf all fiat currencies. And so I actually think that like it may take a while for a lot of this stuff to happen on chain, because I don't know if it's, other than the efficiency of being cheaper and faster, it's that big of a deal for folks. But I think as sort of the crypto native world starts to dwarf the traditional world, I think will kind of like push a lot of that. Those maybe like traditional assets on chain.
Interesting. Yeah, I would definitely say that's probably a bit of a hot take. I feel like I've seen, people have had that concerned question of like, equity perps are coming on chain. If those get a ton of interest, then it's like, well, what happens to all of my alts, type of thing. But yeah, that interesting call out there. We'll have to, 5-10 years down the line, we'll check back in and see, or maybe longer. Who knows? But so far, like stable coins and Bitcoin have been like those two key assets that have grown a ton. So it's I would say to both sides of that, it's really hard to say, right? Because Bitcoin is kind of this entirely new thing, and it's in the trillions now, and obviously dollars themselves are quite large, but stable coins sort of like on chain are still in the hundreds of billions. So
yeah, I guess my hope and what I think is going to happen is like stable coins are sort of laying the rails right now for any sort of tokenized asset to run on, right? Like it doesn't have to be a stable coin. And so obviously that will get a lot of adoption over the next decade or so. But I do think it's just sort of, laying the path for these sort of non-sovereign stuff to maybe more of the cypherpunk stuff to actually go across the same rails. And it's a little bit of a Trojan horse is what I view a lot of this stuff as.
A few more questions here. The one I was thinking about was, Colosseum backs a lot of founders. And with, you guys coming out with Stamp and sort of plugging directly into MetaDAO, do you have the vision that, eventually like any team that does a token that you're investing in via Colosseum is going to do a launch via MetaDAO or sort of via the MetaDAO model, or will you remain more open than that?
Today, like we offer the safe plus token warrant and we offer the Stamp as an alternative. I think a lot of teams that we invest in just don't know today if they're going to launch a token or not. And so for those, like we definitely say don't sign the Stamp because it's kind of a little bit of a one-way door versus the flexibility of doing a token launch. The beauty is that they can sign a Stamp later. If they do the safe and token warrant, they can convert their current cap table through a Stamp to a token launch later. So my personal hope is I think MetaDAO is the best way to launch a token today, like bar none. There are some issues with it, but just compared to everything else, it's way better. So my hope is that, a lot of the teams in our portfolio who launch tokens will do it through the Stamp and do it through MetaDAO. I think that's and I think this is partly why we did the Stamp, is when we talk to teams who are thinking about launching a token, they're like, I can't launch on MetaDAO though, because I have this cap table, I have all these investors. And so how do I migrate over to this token? And we didn't have a good answer for them. So I would expect more than a handful of Colosseum portfolio teams to launch tokens in 2026 and them to do it through MetaDAO.
Cool. Maybe to follow up on that, I'm curious. You said you had some thoughts around sort of the raising process in general. Like, do you think that, like, let's say teams in general, like within the space, all trend in this direction? This like token only, maybe it's stamp or maybe other kind of offerings become available. But generally speaking, it's like a token only approach.
Yeah.
And then into like a market driven raise, do you expect that can kind of eat away at the traditional, like, pre-seed, seed, series A? Like if you can just, do a stamp and then follow that up with a market driven raise into a public token, like, is there a necessity for still all of those rounds, or do you think it would become more common for, a raise or two and then get the token out and you can raise more broadly from, the community?
Yeah, I think it really depends on the founder. I would say the one thing that launching a token, and we let all the founders we work with know this, is that when you launch a token, you're also not just a startup founder anymore. You're also sort of a public markets CEO. And there's a certain skill set that a lot of startup founders don't have initially, or don't even want to deal with, right? Which is dealing with like a token community and providing a ton of transparency and providing a lot of communication. And like, I think all of this stuff is like super important when you launch a token. And so not everyone is ready to do that from the start. And so by using things like the stamp sort of delays that process. And I think we're sort of opinionated though up to a point. Like if you are going to launch a token, we don't want you to get in this situation where one of the problems historically with tokens have been this sort of high FTV, low float problem where teams grow a lot. They build the project that's interesting, but then they raise a ton of venture capital all the way up until like a Binance listing. And then they're launching the token at like a multi-billion-dollar valuation. And then it's down only because maybe retail does not want to invest in a multi-billion-dollar token when there's maybe just not, it doesn't warrant that. And so people are over raising basically from venture on the way up. And so I actually do think that for maybe the way later stages, that's going to get compressed down considerably. And so I think there's always going to be founders that want to take pre-seed and seed capital before going and becoming a public market CEO, right? But after that, I think that's a little unclear if you can just raise from the internet. And there's some benefits of that. Like, I mean, talking with founders who have done this, like it's a double-edged sword to have this community of token holders. One is that they can be quite short-sighted, right? And not long-term aligned like a venture investor would be. However, they can also be like, your first users of your product, your first evangelists. And so, and they grow with you, right? Like part of the beauty of projects like Bitcoin or Ethereum or Solana is that like the community of people who like funded those projects, it almost became a religion, right? For people who kind of wrote it up to its levels of growth, right? And I think that can be really powerful for a startup too, where like you're allowing your users and early supporters to kind of grow with you in a way that a Web2 company can't get. And so, yeah, I think if I had to bet, I think early stage funding is probably safe for now in the medium term, but the later stage stuff will get a lot different. And that doesn't mean like people who are investing in like Series D, E's won't be able to participate. They'll just need to change their strategy. Like they'll become more like public markets sort of investors in the sense of how they acquire assets and stuff. So, which may be actually better for them in some ways, but it'll be interesting to see. I'm not 100% sure, but I do think like just the promise of ICOs was always really interesting, which is like capital formation at the speed of the internet for ideas that maybe even VCs wouldn't care about. For instance, like Ethereum itself was not VC funded. It only got off the ground through an ICO. And so there's other things like that. Like can you crowd sale for things that maybe even VCs don't want want to invest in for whatever reason. Again, going back to the weird corners of the internet, oftentimes the weirdest stuff, we don't know what has not been funded because it's too weird, but maybe I would change the world. And so I'm all for these more open, public kind of crowdfunding sort of models.
Love that. Yeah, I think, for myself as well, I thought the raising kind of capital from the internet, ICOs themselves were sort of my entry point to the space as well. Just like that idea, that thought. It's really enticing. I guess maybe to close out on Stamp and MetaDAO,
Yep.
like, are there, in your mind or from your POV, like, are there remaining hurdles for, the MetaDAO kind of style or even Stamp or related to overcome at this point? Like, what are some things that maybe still need some working on?
Yeah, there's all sorts of edge stuff that we're going to have to work through as teams adopt it and go through the process. And like, for instance, like we're trying to figure out, like, let's say a project raises through a Stamp, and then later on the project fails, and the people want to redeem the token, the assets in the treasury. What percentage goes to early investors versus token holders, right? Up into date, like when you haven't had this private investor carve out, all of it would just go to the public token holders, but that doesn't make sense when you have these other carve outs. How much should go to the team? And then like there's things like that we're trying to make more opinionated. So one thing that we're not 100% we love, which is that some teams going through MetaDAO right now are saying up front, like, hey, here's our team compensation. If stuff works, here are the milestones. Some teams, like Avicii, for instance, they didn't say anything. There is no team compensation today. They're going to have to put up a decision market later on to get basically compensated for building out Avicii. And so things like this, there needs to be more standards around, like, oh, you should do it up front. So actually in the Stamp, we say that everyone who signs the Stamp, you need to make that before the token launch. You need to carve out your milestones and your allocation to team before that. And so there's a lot of, it's super experimental, right? Like this stuff, we don't know exactly how it's going to shake up. We just know it's way better than everything else that exists out there. And so, yeah, not all done for sure. But I think the Stamp itself is in a pretty good spot for teams to start using. And I think, yeah, about a dozen teams are using it right now.
Awesome. Yeah, I think definitely for MetaDAO, like iterating fast certainly seems to have been the model so far. I've seen a lot of, one, you talked about kind of the original design and change from, full futarchy to now the platform with, ownership coins and all that. So they've changed a lot of the kind of core protocol, but also just, kind of experimentally learning through some of these different necessities as things come up.
Yep.
Makes a ton of sense. Shout out to Peaq for sponsoring today's episode. The machine economy is here. Devices are monetizing data for their users all over the world. Tokenized robots are generating revenue for token holders, and the first machine economy free zone is live in the Emirates. And it's all happening on Peaq, the machine economy computer. Head to peaq.xyz to find out how you can benefit from the age of automation. That's peaq.xyz. Thanks to Sablier for sponsoring today's episode. Sablier is the leading on-chain solution for token distribution, trusted by teams like Maple, Immutable, and Axie Infinity. The #1 distribution protocol on EVM is now live on Solana. Automate your airdrops and token vesting, streamed by the second, transparently and trustlessly. Secure, audited, and ready for Solana builders. Get started at sablier.com. As always, investments in blockchain technology involve risk. Terms and conditions apply. Do your own research. Maybe if we get outside of that, just get some of your general thoughts on the broader market. A big topic as of late has been buybacks for crypto protocols. I guess I'd love to get your view here. Colosseum, you guys are investing pretty early stage into teams, and I would imagine you wouldn't expect most of the teams that you're backing to start running buybacks, or most probably don't even have tokens. But I would love your thoughts just kind of on this general topic that seems to spring up every couple of months or years around growth versus buybacks in crypto.
Yeah, I think it just depends on like what the stage of the company is. And it's also just a little bit of a workaround around regulation, right, about doing these sort of inconsistent random buybacks to make it seem like not like a sort of a security, right? And so, but I am sympathetic. Like I'm sympathetic for all the teams that are doing it because they're trying to like provide value to token holders. They're kind of trying to do what we've been talking about that sort of MetaDAO does, just in a different way. However, if you, and I would say almost all startups and companies, even today in the crypto space, at least the on-chain ecosystem, maybe Pump Fund is a good example of this. Like they built a product that's generated a ton of revenue, and they're doing these buybacks on a consistent basis. I think Pump and other projects should be optimizing for growth. I think they should be reinvesting all of the money that they're earning into a better product, into growing their user base, etc. Amazon didn't turn a profit for many years, right? Because they were just reinvesting all of the revenue that they were generating to scale up. And so this is another thing that I think like talking with folks from TradFi are pretty puzzled about, is like, why is this year-old startup doing this sort of buy and burn sort of mechanism when they could be reinvesting that back into product development and growth? So that's my general opinion about it. I think, and again, to plug MetaDAO, I think it kind of gives people the flexibility to not have to do buybacks. It sets expectations. It gives people market protected rights, and it allows people to reinvest that back into product development. So generally those are my thoughts about it.
Yeah, I think that makes sense. I do. Something that I think we see is that when times are good in the market, I think generally more acceptive of teams throwing around money for buybacks or what have you. And then when maybe price action or times are a little bit poorer, then those questions start to kind of like resurface again. And I think we see this kind of cyclically. So good level head to take. I think it makes sense. Yeah. I guess to close things out, I'd love to get your views, maybe just generally or broadly on Solana DeFi. I mean, we're in 2026 now, as of this episode. So I guess in kind of this coming year, going into 2026, like where do you expect to see like the most growth or success for Solana on chain or DeFi, or particular like aspects of it? Is it if it's stablecoin growth or new users coming on chain or particular products? Like what are you most keen on?
Yeah. Well, there's a lot to be excited about. I think I saw, like, I don't know who did this report. Maybe it was Jupiter, but like Solana last year did more trading volume than basically every other centralized exchange, blockchain, L2, etc., except Binance. But even Binance, it's like catching up with. And so I think that trajectory will just continue. I think more and more assets are going to be listed on Solana. I think so it seems like the Solana Foundation has made a push around this of like listing even things like Monad and like getting DEXs to be the first to like list this. I think this is something that Hyperliquid has done quite well, is being like the first to like offer some sort of contract around trading of new assets. And so I think that will continue, where just more and more assets get listed in the Solana ecosystem, and DEXs benefit from that, and front ends will kind of continue to optimize around these things. So like this is another thing that we're kind of betting on, is as like prediction markets and other these like long tail assets and markets get going, there's going to be a lot more, I would say, opinionated front ends around trading those. And so I guess the first version of that we saw with meme coins was something like Axiom, but I think there'll be Axioms for other assets and curation around those assets. So definitely just trading is going to continue to go, berserk. I think obviously these prop AMMs are playing into that. So like Sol USDC, or I think Sol USD / USDC is like more liquid than most centralized exchanges on Humidify. So this is all great. I think there's going to be a lot of sort of, again, like there's a lot of interesting ideas from the past around DeFi that were maybe tried out in EVM or on the Bitcoin talk forums like 10 years ago that are kind of cropping back up and with better teams and more sophisticated teams and products. And so I think Hilo, I think you mentioned that as like a good example of that. And there's a bunch that we've invested in. They'll be coming on to mainnet hopefully this year. They kind of follow that suit. So I think just the number of like unique primitives are going to grow. Stablecoins will just continue to march forward. Especially we're seeing that with international stablecoins, like for remittance or like certain industries. We invest in this project called Cargo Bill that does like billing and invoicing for freight forwarders and so supply chain management, but all stablecoin payments just kind of taking off right now. So I think we'll just see more of just stablecoins. Yeah, and the rails be laid down on that front. So yeah, I'm super excited. I think it's kind of been a weird market cycle over the last like few months where everything seems so positive, like regulation wise, product development wise, novel sort of things happening in the startup ecosystem, at least from what I've seen. And it just seems like things have sort of lagged, but it seems maybe things are picking back up again from a price standpoint too. So that should be also exciting.
Maybe one last question to round it out. I'm curious your thoughts here on, I think we're seeing more of a kind of like merging or like blurring of the lines between like traditional fintech and now like crypto startups. We're getting these neobank products and, using stablecoins as a backend for like what would probably traditionally be like a fintech app or something along those lines. Do you see those terms like kind of blurring or like disappearing at some point? Like, stop calling certain startups crypto startups and they're just fintech apps at some point?
I don't know. The obvious answer would be, yeah, of course, like DeFi just becomes finance. Like that's e-commerce is not, e-commerce still, it's just commerce on the internet, right? And so, of course, that's one way to look at it. The other way to look at it is maybe what I think, and you hear a lot of when people say like, oh, like crypto doesn't take off because the UI or UX is so bad. I actually don't believe that for the same reason why I don't think maybe terms like DeFi or stable coins are going to go away, is because there is enough nuance between how to use like something like Phantom or a hardware wallet or something like that, where you kind of just have to learn how to use it and understand what actually the mechanism is. And even with some of these DeFi protocols, I think it's the same, or yield generation protocols. So I think just as the products get more and more attractive to use, I've found that people will go over the hurdles of learning how to use a Phantom and understanding the intricacies of how a DeFi protocol works. If at the end of the day the product is so good, or the asset that people want is so in demand, that they'll get through these hurdles. And I think we've seen that multiple times with NFTs and meme coins, and people will figure, I don't want to say like the average IQ of a meme coin trader is any lower than anyone else, but like I do think it's interesting that a lot of people have figured this out that I wouldn't have expected to figure out. And if they can figure it out, then a whole other group of people that are much smarter can as well. And so I think actually like it's kind of be like the internet and computers, where it's like, oh, you don't, like, everyone knows what a mouse is, a web address, a browser. Like these things, I think there are things like that in crypto that people are just going to understand as this stuff gets just more valuable to use.
Yeah, that makes a ton of sense. And certainly, like at least on the UI and UX piece of it, there have definitely been improvements there. It's much easier to onboard, cash to a Phantom wallet, for example, than it was 3 or 4 years ago. So certainly there's things that make that transition easier, but yeah, definitely to your point, these things are still there. A hardware wallet is certainly very different from a physical wallet, and probably always roughly will be for the most part. So love that. Great takes, some hot takes, and I think probably like relatively different takes than I hear from most people. I think a lot of people would take that easy out and be like, yeah, eventually, all of finance just is DeFi, they would take that easy answer. So glad you could provide some nuance there, Matty. I think interesting overall. So I was glad to have you on. It was a great episode, and I appreciate you coming on and spending some time with us. Best of luck going into 2026 and with the new cohort. Wishing best of luck to Colosseum and to all the listeners out there. Appreciate you all for tuning in, and you will hear from us next time.
Awesome. Yeah, thanks for inviting me. Bye-bye.
See you guys.